What's up, traders and investors? Welcome. It's TradersArmy.com's Options Foundation series. We are moving on to the options Greeks. Hopefully you guys have learned some things so far that are starting to make a lot of sense in the way that options really work. Kind of some of the ways that the options will give us purpose in our trading and how we can use them to lower risk and increase returns. But this particular web series on options Greeks is one of the is a very important one. Oftentimes, much like volatility, some of the information that's out there on the options Greeks, and then sensitivity to things happening in the marketplace and how our options are priced and all that. Some of that is highly misunderstood. And this is a big one. So we're going to take some good old time today and go through options Greeks. Before we do that, just again reminding you, you can shoot us an email at support@tradersarmy.com. We're happy to help in every way that we can, and we want to make sure that if you have any questions whatsoever about how to trade or how to use options in your trading and investing for your short-term trades or for your long-term investments, then we want to make sure that you can reach out to us anytime here at Traders Army. So again, calls and puts, all the options, okay? So we have the ability in options to take four different positions, four different independent single leg positions: long calls, short calls, long puts, short puts. Now, we've been discussing where it is that we need the market to go if we want to buy calls, if we want to sell calls, where we want where we want the market to go if we're buying puts or selling puts. We talked about our rights, our obligations for buying and selling calls and puts. But what we need to really focus on is understanding how do these options themselves change in value. Because every day you open up an options market and you look at a stock and you look at the options on that stock and you'll say, well, from one day to the next, the options price is changing. As the stock price moves in your favor or against you, the option price is changing. As volatility is rising or falling, the options price is changing. As days are going by, the options price is changing. And so what allows us to anticipate the rate at which our option would change in value, we need to understand what the Greeks are. And the option Greeks are measurements of risk that explain several variables that influence options prices and the way options prices change relative to things like the price of the underlying stock moving for you or against you. Okay, implied volatility moving in your favor or against you, risk-free interest rates working for you or against you, and time. Each day that goes by, that's a constant. That time could either be working for you as an options seller or against you as an options buyer. And these main parts here, interest rates, volatility, time, and the directional movement of the underlying, are what's going to allow our option position to evolve. Okay, so these represent the expected dollar or percentage impact to an option based on these changes. And there are five main Greeks, okay, five main Greeks that if you've ever done any studying on options, you might have come across some of these. Three of them are extremely important, okay? And we're going to be focusing on those three for the most part in this particular web series, because these are the important ones. Because when we open up an option position, what are we really looking for? We're looking for, over a certain period of time, for the underlying stock that we are trading to move in a particular direction, and we want to make sure that we minimize our risk to getting caught off guard by volatility moving against us, and ideally catch a volatility change in our favor. That's the implied volatility we just talked about in the previous web series. If you did not watch the implied volatility web series, I highly suggest going back, watching the implied volatility web series. So we have delta, gamma, theta, vega, and rho. Now, delta, textbook definition, if you look in the dictionary, would be change or rate of change. So what we can expect is that, and I'm going to read through these now, okay, just kind of at a high level, but then we're going to go through describing and showing you examples of what each one really is. So delta, when the underlying stock moves up or down. And by the way, I'm just going to use stocks for now. This would apply to futures, currency, all that, but let's just use stocks for now. When the underlying stock changes in price, doesn't matter whether it's for you or against you, the options premium is going to change relative to its very own option delta. Every single option has its own delta, gamma, theta, vega, and rho. These are values that can tell us the expected change of our option premium relative to changes in the market. So as the underlying changes in value, the options delta would express how much we can expect our option to change in value by. So if you had a $1 change in the underlying, if you had a delta of 40, then your option position would change by 40 cents per share. Okay, if the underlying stock moved by $1. Now, we'll get deeper into that in a second, but delta is related to if the stock moves, how much does our option change? Now, the delta is not a static number. If your option position had a what's called a 40 delta as a just a random number that I'm choosing for demonstration, but if your option had a 40 delta and the stock moved $1, sure, you may make or lose 40 cents per share, but then the options delta would change based on the gamma of that option that you chose to trade. So the gamma is going to affect the delta in either a positive or a negative way, depending upon whether or not the stock is moving in your favor or against you. Okay, so we'll get deeper into that, but gamma is kind of the delta of the delta. Okay, delta representing change. Now, theta is one that, and to kind of help you remember these, D, direction of the stock, D, direction of the stock. Okay, so that's the underlying movement. T, theta, starts that one. This is time decay. So theta is going to represent on your option the expected rate of decay of that option due to the passage of time. And it's focusing on one calendar day. So every single day, including weekends and holidays when the stock market is closed, time is still going by. This is affecting an option's value. And theta is the way for us to actually measure the expected rate of decay on the option that we chose. Vega, V for volatility. We talked about this one in the implied volatility web series. It's the expected rate of change of an option's premium due to a 1 percentage point change in the implied volatility on that stock. Okay. And then rho, rates, interest rates, the expected rate of change of an option's premium due to a 1% change in the risk-free interest rates. Now, gamma is not one that we are going to be watching very closely. We just know it's working in the background as the stock price is moving around. And also, rho is not one that we're going to take a large interest in regularly because interest rates don't really change all that much or that fast enough to really change the value of our option during our options life or the life of our trade. Typically, most of us are using options on a shorter term trading basis, maybe in the trade for several weeks, maybe even a couple of days, some several months, typically no more than about 1 year if you're looking at more of a longer term position on an option. And so within that amount of time, interest rates are highly unlikely, not impossible, but highly unlikely to change really enough to affect our options positions. So where do you find out what your option has in terms of delta, theta, and vega? And again, gamma is here, but we're going to focus on the option chain, and we're going to focus on delta, theta, and vega because those are the most important factors when trading options: time, volatility, and direction of the underlying. So when you pull up an option chain, your options market here will tell you, again, when you expand your different expiration periods of time, you'll see that no matter what period of time you choose, 8-day, 15-day, 22, 29, 36, all the way out to 176 days, that these values, known as our delta, our theta, and our vega, for each one of these strike prices listed down the center of your option chain, call options are on the left, put options are on the right. The options pricing model actually gives us this information. So it gives us the information, but we got to understand what it's telling us, okay? So if you look at this 87.50 strike price on the call option side, you'll see the premium values are here, $1.43 on the bid, $1.48 on the ask. So that's the premium value as of right this moment. But if you look over to the left, you'll see that it has a 0.05 vega a 0.073 theta, a 0.12 gamma, and a 0.54 delta. Now keep in mind, as we mentioned before, each one of these values in an option chain is representing a per share basis. So it's a per share basis and everything is times 100 shares. So when we say you have a 54 delta or a 12 gamma or a 0.07 theta or a 5 vega, this is again referring to your position Greeks or your position exposure. And so we'll go through some examples on how this information is going to affect the option premium. But first of all, I want to make sure that we understand just a couple of simple concepts. Number one, delta. It's the rate of change of our options premium relative to a $1 move in the underlying. So since we have a 0.54 delta, what this information is telling us is that if the underlying stock makes a $1 move up or down, our options premium will change in value by 54 cents. Simple as that. If it moves in your favor, you'll make 54 cents. If it moves against you, you'll lose 54 cents. Okay? Just based on delta alone. And again, the gamma would kick in after the stock starts to move and change the delta relative to whatever the gamma happens to be. But again, gamma is not one of the most important ones. Delta is. Theta, 0.07 theta with a negative sign in front of it. It'll always have a negative sign in front of it. You'll notice that all theta, no matter how short-term or long-term the option is, or how whether we're talking calls or put options, all theta is always going to be negative when looking at the option chain. Why is this the case? Well, whether you've bought the option or sold the option, it still doesn't matter. The expiration date is happening. It's getting closer. And so every single day, the option's value is decreasing by a certain amount of pennies per share. That's your theta. Every day we get closer to expiration. Okay, so every day we get closer to expiration, this option is going to lose 7 cents per day. If nothing else happens, this particular option, the 87.50 call option, will lose value by 7 cents per day. And that will start to get faster. It'll accelerate the closer you get to expiration. I'll explain how that works here in a few. And your vega exposure is if implied volatility, which we looked at in the previous web series again, changes by 1 percentage point, this option's value is expected to change by about a nickel per share. Okay, so all of these factors are going to factor in. If the stock price is moving, volatility is changing, time is going by, they're all going to impact this option premium. And this option premium is what exactly, this is what we're trading. So if you're going to purchase this option and pay this premium, the ideal scenario is you have certain factors working for you as often as possible, so that when we turn around and sell this option, we can sell it for more than what we bought it for. But if you don't understand how vega and theta and delta will affect this position, you may buy this option expecting to sell it for more in the future and be sorely disappointed when you can't get any more money for it, or worse, you get less money for it when you want to sell it in the future. Now what you'll notice is some of these values, we're going to dive into this, some of these values are different. Values depending upon whether you're close to expiration, in this case 8 days, or further away from expiration, in this case 176 days. So we'll just focus on the call side for now and then we'll move to the puts. Okay, so the call side, notice that your at the money current strike price 87.50, your at the money option delta is a 54 on an option that expires in 8 days, and it's a 55 on an option that expires in basically almost about 5 months. So the deltas at the money are going to be relatively the same. As you go in the money and out of the money, the deltas will certainly change, and I'll explain why as we get into delta even deeper. Theta, which you'll notice is theta is substantially higher closer to expiration than it is further away from expiration. If you were to buy a 176-day option, you'd only lose 2 pennies per day based on time going by, versus if you buy one that expires 8 days from now, you're losing 7 cents per day as it gets closer to expiration. And your volatility exposure is very low close to expiration, where your volatility exposure, your vega, is actually very high close to further away from expiration. And this is going to be the case whether or not we're talking call options or put options. The only difference really is when you look at the put options versus the call options on the left, you'll notice that all the deltas on the calls have they have no symbol in front of it. The puts have a negative symbol in front of it. What this means when it doesn't have any symbol in front of it, it's a positive. Okay, it's a positive or a negative. So you'll have positive delta or you'll have negative delta. Okay, now when you establish a position, we are going to be looking at this particular graph quite a bit. Okay, so depending upon your position, long or short, calls or puts, your option will either be positively or negatively impacted. Okay, again, I'll say it again. Your option premium or option position will either be positively impacted or negatively impacted based on rising underlying price, rising implied volatility, rising interest rates, and time going by. And so if you look at the put option here, if you recall, which way do we need the stock to go if we buy puts? If we buy puts, we need the stock to go down. So if you buy puts and the stock goes up, this is a negative. This is negatively impacting the position. Okay? When stock prices go up, this is negatively impacting the puts. When stock prices go up, this is positively impacting calls. As time is going by, theta, time is always a negative for every option out there. Not for every option position, as I'll explain later, but for every option out there, time is always working against it because once it gets to expiration, all the time value is gone. Volatility rising will always cause the options premium to increase in value. So when you look at this graph, you'll see long calls and puts. You'll see whether or not a long call is going to, which basically direction you need the stock to go. You need the stock to go up. It will positively impact your position. Time going by negatively impacts your position. Volatility rising positively impacts your position. Interest rates rising positively impacts your position. You look at long puts, that means you bought them. Price going up negatively impacts your position. Time going by negatively impacts your position. Volatility going up positively impacts that position. Short calls, price going up negatively impacts your position. Time going by positively impacts your position because remember, you sold an option to someone else who is losing value every day. Therefore, you, the option seller, get to make or keep that value every day. So time going by is a positive for anyone who sold an option. And volatility rising will negatively impact the call seller as it positively impacts the call buyer. Short puts, price going up, positively impacts, meaning the underlying price going up, price rising, positively impacts your position. Time going by positively impacts your position. Volatility going up negatively impacts your position because you sold a put option to someone who will benefit from volatility rising. So therefore, if someone's going to benefit from volatility rising, someone has to lose from volatility rising. When someone is losing due to time going by, someone has to benefit due to time going by. Okay, and so you'll see that we have a position that we could take, long or short, or as we get deeper into spread trading in the advanced web series on different types of spread trades, you'll see we're going to be combining long and short option positions to create combinations of option Greeks. So we'll get to that much later. Let's first focus on some of the basics here. So delta. Let's focus on delta for a bit. Again, delta is something that is ever changing relative to the gamma, but what you'll notice about delta is that, again, it does represent the expected change of your option premium relative to a $1 move in the stock. Okay, so what I want to focus on first is the image on the left. This is known as our delta curve. Delta curve, this is visually representing what happens to your options delta, not your option premium, what happens to your options delta as the stock price goes up or as the stock price goes down. Okay, so we're just focused on calls first. So on this graph, you'll have two axes. One is the vertical axis, that's your delta. Your horizontal axis is the stock price. So if the stock price is going up, your delta value will rise. It'll get higher. If the stock price is going down, the delta value will actually get smaller. It's important to note here that your delta value can get no smaller than 0, and it can get no bigger than a 1. Okay, it cannot get bigger than dollar for dollar. What that means is that if you had a delta of 1 on your option, what that would mean is that if the stock price moves a dollar, your option position changes by a dollar. Typically, we're going to be starting out in a position where we are using more at-the-money options, especially when buying them, and we'll get to strategies in a bit. But an at-the-money option is always going to have relatively close to a 50 delta or 0.50 delta. If you look back at the graph here, you'll notice that the 87.50 call options, okay, and put options, this is pretty much right at the money, have about a 50 delta. Now, it could be a 51, a 52, a 54, a 53, it could be a 55, but somewhere around a 50 delta is always going to be an at-the-money option. Now, what if the stock price starts to move up? Well, if you bought the call option and the stock price starts to go up, well, that's good. That means you're making money. And notice the rate at which you make money actually increases. So you get to make money at an increasing rate of speed as long as the stock is moving in your favor. Now think about that for a second. You get to make money. Making money is one thing as the stock moves in your favor, but making money at an increasing rate of speed is even better. This is what is referred to as dynamic leverage in the options market. You're making money, you're using leverage of the options, and it's dynamic, suggesting that the more right you are, the faster you make money. Now, what if you're wrong? What if you're wrong and the stock price is going down and you purchased a call option? Well, that call option is losing value, all right, based on its delta. But notice what's happening to the delta as the stock price goes down. That delta is actually losing value, and it will eventually reach 0 if you hold on to it all the way to 0, which means your option is actually worth nothing if the delta is 0. But as the stock price is going against you, it's one thing to lose money, as we would be doing here, but notice the rate at which we lose money is actually slowing down. Imagine that. You make money quickly, lose money slowly. If you've never thought about that as far as options are concerned, this is a gigantic benefit to the rate of return that you get on your positions. Making money at an accelerating speed, losing money at a decelerating speed is only something that occurs in the options trading market. Very, very powerful stuff. Okay. Now, this is your call option delta curve on the left. Now for put options, it's the inverse because put options will actually increase in value as the stock goes down. So put options increase in value when the stock goes down. Call options increase in value when the stock goes up. Okay, so if you buy a put option, every option is going to have a negative delta when you buy puts. Okay, so we're using long puts as an example here, just to illustrate the point. So where do you need the stock to go if the put option is purchased? You need it to go down. If the stock goes down, your option delta will actually increase in the speed at which it makes money. So why is it negative again? Well, remember, if the stock price goes up, that's a negative. Okay, if the stock price goes up, your options become deeper and deeper out of the money. Out of the money is what OTM stands for, out of the money. And your options premium is actually losing value. Again, it's losing value at the rate of its option delta. So as the stock price goes up and works against you, notice you're losing money, yes, but you're losing money faster or slower? We are losing money slower. So it's a good thing. We're losing money at a slower, decreasing rate of speed. Now, if the stock price happens to be moving down, which is good for you, your options delta goes up, which means you get to make money faster as the stock moves in your favor. and that option becomes deeper and deeper in the money, and as it becomes deeper in the money, the options delta would continue to increase until it reached a maximum delta of -1. Okay, maximum delta of -1. Okay, so you would never be able to see a greater delta than 1 or a smaller delta than 0. And again, typically we're going to be starting out somewhere around a 0.50, and you can see here that roughly the at the money option, 87.50 put option, has around a 50 delta. Now, what you'll notice is something pretty cool here, which is if you add up the option delta on the puts to the option delta on the calls, the total delta value will be what? It'll always be right about 100, a 1 delta. Okay, that's going to come in super handy a little bit later when we start to look at options delta as a measure of probability, because another use for options delta other than the directional move of the underlying is the probability that that option has any value whatsoever at expiration. So think about that for a second. If this option delta represents the probability of that strike price having any value at all, any intrinsic value at all at expiration, there's 100% probability that either the 87.50 calls or the 87.50 puts, one of them is going to be in the money by even 1 penny at expiration. One of them has to be. So there's a 100% chance of one of them being in the money at expiration. Now, if you look at the call option is already in the money. That's why it's highlighted yellow. The put option is not in the money. That's why it's not highlighted in yellow. Now, therefore, the fact that it's already in the money by a little bit means that there is a slightly higher probability, in this case 54% chance, because it's a 54 delta, 54% chance that this particular call option ends up in the money at expiration 8 days from now. Whereas their 87.50 puts only have a 45.8% chance of expiring in the money 8 days from now. Okay, if you look at something that is a little bit deeper in the money on the calls, we'll go to the 85 calls. Because we only have 8 days left, there's an 80% chance those 85 calls are going to expire in the money. Well, if there's a roughly 80% chance the calls will expire in the money, then that would mean there's a nearly 20% chance the put options will expire not in the money. Okay? If you look at the deeper in the money calls, the 82.50 calls 8 days from now have a 94% chance of expiring in the money. Well, if those calls have a 94% chance of expiring in the money, 94%, then those same puts really only have a 6, maybe 7% chance of expiring in the money. You guys getting this correlation here? Now, what about the out of the money calls? So the $90 calls 8 days from now only have a 26% chance of being in the money at expiration because there's only 8 days left. That being the case, there's about a 74% chance the puts expire in the money, those same strike prices, because they're already in the money. There's a higher probability they will expire in the money. Okay? Now, what you'll notice is that when you go from an 8-day option out to a 176-day option, with more time comes more probability that out of the money options, anything that's not highlighted in yellow, out of the money options could become in the money. There's a higher probability they could become in the money and be worth something at expiration because there's 176 days left for that to happen. Which means that if there is a higher probability the out of the money options could become in the money, there's also a probability associated with the current in the money options becoming out of the money at some point in the future, considering there's 176 days left. So the option values are going to evolve as days go by, and the closer you get to expiration, the you'll see the delta values change in almost a bell curve shape. And I'll kind of describe what that looks like. I have a graph for that as well. What I mean by bell curve is that if you could kind of turn your head sideways and look at this delta graph, the highest deltas are at the money, and then it really goes deep in the money, delta of 1, and then it really quickly drops near delta of 0 when you're close to expiration. But if you look at a sideways bell curve here on these 176-day options, it's not quite as steep. We don't go to a delta of 1 on something that has so many days until expiration, because what does a delta of 1 represent in terms of probability? In terms of probability, there's a 100% chance the 7250s expire in the money 8 days from now. Well, the 70 and $75 call options over here with 176 days, the pricing model is not going to put a 100% chance of anything happening 176 days from now. So you get a more gradual incline in your delta curve on a longer term option than you do on a shorter term option. You get a very drastic spike from in the money options, at the money, to very quickly going to a 0 delta on an out of the money option. So something to notice there on your options delta, and time going by is going to affect the way that that delta position evolves as well. But for standard purposes, you can kind of see here, as we're just describing what these factors are, not how to actually use them or apply them just yet. These are just what are they and how can we understand how these changes affect the option premium. When the stock price goes up, that will positively impact an options delta. If the stock price goes down, it will negatively impact the options delta, and that's on a call option. Put options, as the price of the stock is going down, that's positively impacting your position. As the stock price is going up, that is negatively impacting your position by the rate of change known as delta. Now next, we're going to look at theta, time. Okay, what you'll notice about theta, again, is that it's always negative on an option itself. We're not talking about your option position yet. We're just talking about the option themselves. Options themselves will reduce in value each day just due to time going by, all other factors remaining equal. What you'll notice is that, I'll say it again, a closer to expiration option will have a higher theta than one that's further away. And that is simply going to be described no better than looking at this graph. Okay. Now, when you think of an option, think of an ice cube, especially when it's pertaining to its theta or time decay. And this ice cube, the moment you put it into the palm of your hand, will immediately start to melt just because it's an ice cube. That's what it does. Okay. It gets, it starts to melt just because of the warmth of your body. Now, as you push that, as you maybe move your hand closer to some heat source like a fire, or you move your hand closer to the fireplace, well, the ice is going to melt even faster, okay, because it now has additional heat putting pressure on that ice cube, and it's going to melt even faster. So in this example, or in this analogy, the fire over here is our expiration date. Okay, so this is our expiration date all the way to the right of our horizontal axis. The ice cube is how much option premium we purchased. So we pay for an option. Okay, so an option's premium due to its extrinsic value. This time decay cannot affect the intrinsic value. It can only affect the extrinsic value. Remember, the extrinsic value is time, volatility, interest rates. The intrinsic value can only be affected by the stock price moving up or down, causing the option to be in the money or out of the money. Okay, if it has intrinsic value, great. If it doesn't have intrinsic value, that's also fine too, but ultimately the time decay or theta is only affecting the extrinsic value of the option. Therefore, also consider this. A shorter term option has less extrinsic value than a longer term option. Why? Because there's more time in that option long term than there is a short term option. So therefore, the theta would not impact a longer term option quite as fast as a shorter term option. If it did, if a longer term option had the same theta decay as a shorter term option, then our longer term option would reach zero long before expiration date. Therefore, a longer term option has to start out decaying slowly, slowly, slowly. And as it gets closer to expiration, it actually speeds up how quickly that option decays. Okay? And what you'll notice is that if you look at the area under the curve here, what I mean by that is, let's say that these represent months. So 5 months of time until expiration. You buy an option that has 5 months left of time. When 1 month has gone by, if you look at the area under the curve here from this line, it has decayed a little bit, but the amount of extrinsic value that the option has lost is very minimal, just due to time. Now, what if the stock price is moving against you? Well, then your option has lost more value. If volatility is moving against you, your option has lost more value. However, if the stock price and or volatility is moving in your favor, that will offset the time decay effect. So you'll make money on one thing like delta and volatility. You might be making money there, and as long as you're making enough money to compensate for this decay just due to time, then you may actually still be making money. Okay, now as you get closer to expiration, you go another month goes by, more money will depreciate from the value of that option, yes, but it's still decaying at a very slow rate. So the option itself is still worth 80% of what you paid for it relative to just the time decay. Okay, but as you get closer to the expiration date, in this case it's the fireplace, as you get closer to that fire, what is happening to the value of that option just due to time? Well, it's starting to decay even faster. And as you get within 2 months of the expiration, its value is decaying even faster. And what you'll notice is that of a 5-month option, if you get within 1 month of its expiration date, the first 4 months has cost you roughly 40 to 50%. Actually, we'll just call it roughly 50% of your option's extrinsic value just due to time going by, which means in the last 30 days of its life, the rate that option will decay as it gets closer to expiration will end up being faster. Okay, will end up being faster. So think about this for a second. We could be buyers of options, we could be sellers of options. As we get into options trading strategies and rules down the road, would you want to buy an option that only has a month left until it hits expiration? Would you want to own an option in the last 30 days of its life? Yes or no? No, we would not. Not if we planned on holding it, I guess. Not if we planned on holding it for several days, weeks, or even the entire month. Why? Because we will be losing value quickly due to time decay alone. Okay, we would not want to own an option in the last 30 days of its life. We want to own an option that had some time to it, even if we weren't planning on using all 5 months. It is important that we purchase an option that has 3, 4, 5 months worth of time left. This way the decay factor really isn't hurting us all that much. Now, if we were planning on shorting options and selling them to somebody else, would we want to sell someone else an option that expires in under a month? Yes, we would. We want to sell somebody else this vehicle that's costing them money quickly. This way we make money quickly. Okay? We wouldn't necessarily want to sell a long-term option because we don't get the benefit of theta working for us quickly. And hopefully that makes sense to you. As we get deeper into the strategies, we'll make sure that we give you guys some parameters on what to look at when building out different option positions. But moving on to Vega here, our volatility exposure. This is a big one as well. We talked about volatility in just the previous web series. But Vega, again, is volatility changing is really only going to affect the option's extrinsic value. So again, the fact that there is less extrinsic value on a short-term option than there is a long-term option, your volatility exposure on a long-term option is greater than a short-term option. And one of the best ways to really illustrate that is this. In fact, I'm going to go back for a second to remind you that vega, again, represents if implied volatility changes by 1 percentage point. Okay, what does that look like? Remember, down here on our volatility, this is the, call it the S&P 500. Right now, S&P 500 index, ETF. Implied volatility right now sits around 11%. Notice where I set my cursor, and then notice all the way to the right, it's 11%. And I'm looking at this little red line right down here. If implied volatility continues to rise by 1 full percentage point or falls by 1 full percentage point, then our option will change in value based on whatever its vega value is. Okay, so if we were using a short-term option, our vega exposure is only 5 cents per share if volatility rises or falls by 1 percentage point, because there's not much extrinsic value left in that option, being that it only has 8 days left. But if you got to a longer term option that has more extrinsic value, then our volatility exposure is greater on a longer term option because it has more value to the extrinsic portion of the option's premium. So when you have an option that, again, is close to expiration, if you get no change in the volatility, if that volatility graph does not change during the life that you are holding this option position, then your vega is irrelevant, right? If options volatility doesn't change, then that's not impacting your option at all. But and that goes for short-term options and options that are further away from expiration. However, if we get a rise in volatility or a decline in volatility by 1 percentage point, 2 percentage points, 3, 5, 6, 10 percentage points. Let me take a quick look here, look back at this. We could see a rise from 11 percentage points up to 15 percentage points. And that would still not put us all the way at the high for the year. The low for the year is 9% implied volatility. The high for the year is 17% volatility. If you got a rise from 9 to 17% or a fall from 17 down to 9, okay, that would be a 8-point move in volatility. 8-point move, 8 percentage point move in volatility. So imagine what would happen if you got an 8 percentage point move in volatility and this occurred on a short-term option. Well, you wouldn't be impacted all that much. Yeah, it would rise a little bit or it would fall a little bit, but not all that much. But if you got an 8-point move on an option position and your option was further away from expiration, look how much more volatile your option premium would be just due to a small move in implied volatility, just because you're dealing with more extrinsic value on a long-term option. Again, just a reminder, the more extrinsic value you have in your option, the more exposed you are to what? Vega and theta. You're exposed to time decay and you're exposed to volatility changes, okay? Because they, again, only impact the extrinsic value. So a percentage change in implied volatility will impact a longer-term option more than it will impact a shorter-term option. A 1 percentage point change in implied volatility, that's what IV stands for, implied volatility, will also impact an at-the-money option more than it will an out-of-the-money option or an in-the-money option. Why is that? Well, remember, in-the-money options and out-of-the-money options, they have less extrinsic value than the at-the-money options. So always, 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 at-the-money options will always have higher extrinsic value exposure, higher volatility exposure, vega exposure. In-the-money and out-of-the-money options will always have lower vega exposure because they have lower extrinsic values. Now, what about the intrinsic value? Okay, there is no intrinsic value on an out of the money option, but there is plenty potentially intrinsic value on an in the money option. But remember from a previous web series, when you have intrinsic value, the more intrinsic value you have, the less extrinsic value you have. If you forget about that, go back to a previous web series. That is on the very first web series, What is an Option Anyway, and also premium calculation. Very specifically, premium calculation details that concept of in the money options, extrinsic value versus out of the money options versus at the money extrinsic value. So remember, what we're focusing on here is two things. We're talking about extrinsic value due to close to expiration, further from expiration, and whether they're at the money, in the money, or out of the money. So the red line is a long-term option position. Blue line is medium term. Let's call it 3 to 4 months out from expiration, and the green line is short-term options. Remember, from this graph, close to expiration, very little impact due to volatility changing. Medium-term expiration, greater impact than a short-term option. Much further away from expiration, much greater impact due to volatility changes. So, on an at-the-money option, long-term, we have the greatest exposure to changes in volatility. On an at-the-money option, short-term, that's the green line, we have the least amount of exposure due to volatility, but the highest exposure to time, or theta. And we have the blue line, which represents a medium-term option. Give it 3, 4, 5 months worth of time, and we have slightly less exposure to volatility changes than a long-term option, but more exposure than a short-term option. And this again details out the bell curve, which represents your overall exposure to volatility changes. Now, just to kind of keep things fun and keep you thinking, what I have done, what I like to do, is to kind of put all of this together and take each one of these positions along with the original graph that we saw showing positive or negative impact, okay, and kind of give you some examples. And let's go through an example here. Let's say example number one. Example number one, we are long an at-the-money call option. It cost us $3.55 or $3.50 per share. The option itself has a delta of positive 0.52, gamma of 0.06, negative theta because we are long in at-the-money call, and it's positive vega by 0.14. Now each of these are going to be per share values. So when we pay $3.50 per share for this option, what are we expecting? We're expecting that the stock is going to go up. We're expecting this to happen over a certain amount of days. And we're hoping, and if we planned our trade right, we're expecting volatility to go either nowhere or go up. Because if volatility goes against us, that's going to hurt us. Okay, so let's just do some math here and have some fun. So if the stock price went up $1 over 4 days and volatility happened to go up by 2 percentage points, how would that impact the value of our option based on this information? So watch, our starting value is $3.50. Looking at the stock price going up by $1, we take our delta and we add 52 cents to the options premium. Okay, because options going up $1, that's a 52%, that's a 52 cent positive correlation. Okay. Now, so we made 52 cents on the stock price moving in our favor by $1. However, it took 4 days to move $1. That's going to cost us 9 cents per day. So 9 cents per day times 4 days, that's 36 cents we lost just due to time decay. So we got to subtract 36 cents from that. But because volatility went up 2 percentage points in our favor, that's a positive for us, we made 14 cents per percentage point. Therefore, we just made 28 cents. We just made 28 cents on volatility rising in our favor. When you start with 350, add 52 cents because of your delta, subtract 36 cents worth of theta, but add back in 28 cents worth of vega or volatility exposure, you now have an option that is worth roughly $3.94. So what you paid $3.50 for, all this stuff that occurred, caused your option to be worth 44 more cents than what you paid for it. So if you sold the option right now, you make 44 cents, which is over a 10% return on your original option. Cool, right? So what I like to do is I like to kind of go through different exercises to help us understand how these factors are going to impact our overall option premium. Now remember, these are dollars per share, so these will always be multiplied by 100 shares when you're trading standard options on stocks and ETFs. So this is $350. This is $52, this is $36 and $28, which means your new value is worth $394 total dollars. So you made $44 total profit on a single contract on your $350 investment. Cool? All right, moving on. Example number 2, the person who was short that call, okay, who is short, not that call, but short a call, let's say sold an out-of-the-money call option for $2 a share. So they bring in $2 a share. Okay. Now, we have to earn the $2 a share. The person on the other side still has an option that's worth $2. So we just brought in $2 a share worth of premium for selling that call option. So let's say the stock goes down by 50 cents. 10 days goes by and volatility goes down by half a percentage point. Half a percentage point. Now we brought in $2, that's our starting value. Stock price goes down by 50 cents. Is this a good thing or a bad thing? Remember, if we sell call options, we need the stock to remain where it's at, neutral to bearish bias. Therefore, if the stock price goes down by 50 cents, that's a good thing. The person who bought this call needed the stock to go up and they're losing right now, but the fact that we sold this call option and the stock is going down, that's a good thing for us, right? So, the person who's losing is losing 40 cents per dollar, which means we're making 40 cents per dollar. But the stock didn't move a dollar. It only moved half a dollar. So we don't get the full 40-cent benefit. We only get half of the 40-cent benefit. So we're just going to subtract 20 cents because we only get half of that delta move because the stock only moved half of a dollar. Okay, so we'll subtract 20 cents from the $2 we collected, and we have earned that 20 cents. Now, 10 days have gone by, and we'll just use an example that says this theta value is static. So at 12 cents per day, we're going to make 12 cents per day. That's a positive. As 10 days have gone by, that's a positive to us. That's times 10 days. So we've just made $1.20 on just time going by. So even if the stock didn't move, we still would have made $1.20 of our $2 because 10 days went by. So we'll subtract another $1.20 from the option premium, and volatility goes down 0.5%. This is a good thing for us. If volatility went up instead, that would be a negative. If volatility went up, that would be a negative. That's our volatility exposure. But because volatility goes down, that's a positive, but it only went down half a percentage point. So we only get half of the vega. So we subtract 4 cents from that half of volatility point move. And if we subtract 20 cents delta, $1.20 theta, and 4 cents vega, we are left with a 56-cent option value. So what we sold for $2 is now worth 56 cents. Think about that for a second. What you sold for $2, you brought in $2. You could buy it back right now and close your position for 56 cents, which would mean you get to keep $1.44 of the original $2 that we collected when we were short or sold this out-of-the-money call option. So these factors all worked for us in this particular example. Stock price went down some, time went by, and volatility went down. We made $1.44 of our potential $2 per share. So $200 came in. If we want to buy it back, 56 cents goes back out of our account. We keep 144 bucks per contract. Fun, right? Cool stuff. Now, example number 3, we are long, which means we're buying an at the money put. Now, in this example, we're going to buy a put for $4 a share. So that costs us $400 a contract. Now, the example is stock goes down by $1, 5 days go by, and volatility drops by 3 percentage points. Now, let's look up here at our example Greeks, delta, theta, and vega. Well, if the stock price goes up, that's a negative for us. If time goes by, that's a negative for us. If volatility goes up, that's a positive for us. Okay, so what do we want? We want the stock to go down, and we want volatility to go up. And we can't stop time, so that's always going to be a negative in this position. Okay, so stock price goes down $1. That's a good thing. So if it goes down by $1, we can add 55 cents delta to our original premium because we make money as the stock price goes which direction? Down. And we make 55 cents as the stock went down a full dollar. 5 days have gone by, however, so 7 cents per day in theta cost us 35 cents per share because 7 cents per day, 5 days, multiply that, you get 35 cents lost just due to time decay. Now here's a fun one. Volatility went down. Now volatility going up is a positive. Volatility going down, that's bad. That's volatility working against us. So we are exposed at 10 cents per percentage point. So if it dropped 3 percentage points, we just lost 30 cents due to that move. So watch. We take our $4 starting premium that we paid. We made 55 cents on the option delta, but we lost 35 cents due to time, and we lost an additional 30 cents because volatility dropped. So when you do all this math, you add 55 cents, subtract 35, subtract 30, the new options value is $3.90. Now let me take a time out and make a point here. Most people only think when they get into options that they need to be right on direction to make money. Okay, all they're concerned about is direction, direction, direction. If the stock price moves in my favor, I will make money, and that is wrong, that is false. This proves it. Watch. Time goes by. That affected us negatively. Volatility goes against us. That affected us negatively. Let me ask you a question, folks. Did the stock move in our favor, yes or no? Yes, the stock did move in our favor. It moved in our favor by $1. So we should have made money. Except time and volatility worked against us, so what we paid $4 for, it actually cost us 10 cents, right? All of this put together, we lost $10. Now, I know it's not a lot, but it's going to baffle people who don't understand how Greeks affect their options positions because they can't understand, they haven't really studied options enough to know that it takes more than just being right on direction to make money in options. We want to put as many factors in our favor as possible, and this will baffle people because they'll say, hey, the stock moved in my favor. How did I still lose money? I don't understand. And they'll say things like, options are risky, options are too complicated, I don't understand it, I quit. And they quit 2 feet from gold, man. All you have to do is understand some basic fundamental principles and understand how to build the right option position to avoid these exact scenarios. Okay? So again, this is an example where we were right on direction, but we still lost money. Why? Because time and volatility took away some of our delta profit. Actually took away all of our delta profit and 10 cents of our own money. Okay? Cool stuff. So example number 4, last example before we wrap, where we are going to be short or selling an out of the money put for $1.50 per share. So we're going to bring in $150 when we sell this put to open this position. Remember, we are short, so we are selling to open an out of the money put option. Now, which direction do we need the stock to go? Well, we're thinking the stock is going to remain neutral as a short seller of this put or go up, right? So we want it to stay the same or go up. Keep that in mind. The example is short the put, bring in 150 bucks. Our delta, theta, and vega position would look like this. So if the stock price goes up, that's a positive for us. As time goes by, because we're short, that's a positive for us. As volatility rises, or if volatility rises, that's a negative for us. So we'd like to see the stock price go up, time go by, and volatility go down. That's what we would like to see. Okay. So in the example, the scenario is stock goes down by $1. It doesn't go up, it actually goes down. It works against us. So this is working for the put buyer. That's not good. So the put buyer is going to actually see their option increase in value by 38 cents because the stock made $1 move down in their favor, not ours. So what we sold for $1.50 just got 38 cents more expensive. Ouch, that's not a good thing. However, it took 10 days for all of that to occur. So over those 10 days, that time going by was a positive for us at 11 cents a day. So we just picked up 55 cents positive. That helped us. So we get to subtract 55 cents from that option because it hurt the buyer every day to hold on to that option. They lost 11 cents a day. We made their 11 cents a day. Okay, so we subtract that 55 cents from the premium, and volatility went down by 1 percentage point. So that's bad for the buyer. That's good for us. So we get to subtract that 7 cents. Vega, because it moved 1 percentage point. So as the stock price went down over 10 days and volatility dropped 1 point, we take the $1.50 starting value, add the 38 cents because that's working against us, but subtract the 55 and the 7, that's working for us, and the new options value is $1.26 per share, 126 bucks. So did we make or lose money? Well, we sold something for $1.50 to open this position. If we wanted to close it right now, we'd have to buy this option, and the new options value is worth $1.26. So if we sell for $1.50 and buy it back for $1.26, well, we've made 24 bucks. We've made $24 per share, 24 cents per share. That's $24 per contract. So we made money, but the option is still worth $1.26, and there's still time until this option expires. And so we could choose to either buy it back and make our 24 cents return, or we could hold on a little bit longer, and every day that time goes by is going to be paying us. If volatility continues to drop, that's a good thing. But if the stock continues to go down, that's going to hurt us. And some things to consider when we actually go and start actually building options positions, meaning we got to have a stop loss on this thing to keep us from losing too much. Okay. We're going to have very specific rules as we get into building options trades, long calls, long puts, short calls, short puts. We're coming up shortly in these web series. We've got one more foundational principle to cover, and that's looking at options risk profiles and options risk graphs. Then we're going to go into strategies where we're putting all of this together. So hang on tight. It's about to get serious. This was a little bit of a longer web series. But I hope you got a lot out of it. You may want to watch this one a couple of times. You may even go back to watching this one again and again, especially after we've gone through the actual options trades and the rules around it to further understand why we build trades a certain way. If you have any questions about this web series or any other web series that comes to mind, again, shoot us an email, support@tradersarmy.com. We'll be happy to help in every way that we can. Thanks for sticking with us and joining us on this web series on the option Greeks. We'll see you here next time.